Well, hello, this is Ken Himmler, and welcome back. We are here to really talk about something very important, which is tax reduction strategies on retirement plans. There have been some recent developments that I'm going to fill you in on, and some of the strategies that you can utilize in these trying times. So, I want to start off just by talking about the economic mapping that I did back in the beginning of March. So, back in March, when this entire tragedy started to happen, I sat down and mapped out what I thought was going to happen based upon some of the modeling that I did with some of the finances, where we were with interest rates, where we were with the stock market, what I thought that would happen with this shutdown and the unemployment. And back in at the beginning of March, I outlined that strategy as you're seeing appear here on your screen. And originally, if you look at that first red line, and that's what we're really here to talk about today, is the income taxes. I originally estimated that we would see a big increase in income taxes starting in January of 2021. I'm revising that now and stating that I really believe that this is going to happen more into 2022. The reason is that the stimulus package took a little bit longer to get out the door. It took a little bit longer to get implemented. A lot of the states that I estimated would take the responsible action did not. They waited weeks to do shutdowns and stay-at-home rules. That exasperated the spread of the virus. And so in my original modeling, I'm about a month behind in what I thought would level out. Again, you can never really gauge the responsibility or irresponsibility thereof of humans. And because of that, the devastation has caused such irreparable harm to the American public that this stimulus package is going to take a little bit longer to get out the door. Now, what that also means is that the income taxes that I predict are going to happen are going to take a little bit longer to implement. My estimate is that by the summer of 2021, we are going to see a lot of the tax laws change, and then either retroactive back to January 1st of 2021 or starting in 2022. If you ask me what my guesstimate would be, they'll make it retroactive to 2021, the January 2021, because our country is going to be hurting for tax dollars. Let's talk about what the real goal of tax planning is. The number one goal, reduce tax. That increases your net rate of return. Always what I tell people is whenever we save money somewhere, don't just bank it. That isn't good enough. Put it to use in what I call the velocity of money funnel. What that means, I'll give you an example of that. Let's say that somebody comes to us and we save them $30,000 a year in income tax. Of that $30,000, I'm going to look to reapportion that to something that will make more than just putting it into the bank. So what we'll do is an analysis. We'll say, if we reinvested this in the market, what is our potential? If I make an estimate of 6, 7, or 8%, then I'm going to compare that to what if we took and bought a piece of rental property. And now if I take $2,500 a month, I might be able to afford to leverage a $300,000 to $400,000 piece of property. This way I'm using money I would have given to the tax man, and I am now building a better net worth. Now, some people might not want to go down that route. I might now look to maybe reduce debt. If a person has 10% debt, that's like making 10% of the money. If the person says, hey, all I want to do is just, save the taxes, then what we might do is we might say, well, what would happen if you saved $25,000, $30,000 a year in tax? What are you going to do with that money? They might say, well, I'm just going to leave it to my heirs. Okay, well, now what if we took that $25,000, $30,000 a year and we went and bought a $5 million or $10 million policy? Instead of leaving them $30,000 a year, you might be able to leave them a $5 or $10 million lump sum. So we're always going to look to what can we do to create velocity of money on that tax savings. And the key, what I'm going to talk about today, is really not just saving taxes. While we all love to do that, what do we do with that money? Let's first look at what's happening with the virus strategies. Number one, Roth conversions. These are a big gainer right now because we can take advantage of low prices to get money out of an IRA and convert it to a Roth. Number two is recharacterization of RMDs and even possibly withdrawing that money at a discount. Also, tax loss harvesting. If we have things at a loss, switching them into something that would not disqualify us under the 31-day wash rule, but booking a capital loss that we can use at a later time. Also, location optimization, making sure that we have the right investments in the right accounts. So in other words, not holding high gain stock in an IRA and also not holding a bond in a non-IRA. And also using mortgages and rental properties for what we call tax offsets. And the breaking news is IRS Notice 2020-23. And what this does is this is going to give us an allowance that if you took your distribution from your IRA, your RMD, between February 1st and May 15th, you can now undo it. Your deadline is now July 15th. We can either move the funds or the stock shares that you took out to satisfy your RMD back into the IRA. We can also, I want you to note though, RMDs in 2020 are waived for the primary account holder and the spouse, but not for the beneficiaries. So if you hold a beneficiary IRA, you still have to make your RMD for 2020. Now, if you've already done a 12-month rollover, you may not use this new tax ruling. What is a 12-month rollover? Let's say that you decide that you want to invest your IRA in something else. You call your IRA company. You say, send me a check. They send you a check. Within a 60-day period of time, you roll it over into a new IRA. That is what's called an IRA rollover. However, many people are confused with the 12-month rule. An IRA rollover is different than an IRA transfer. If you have, say, Fidelity, and you want to move your IRA to, say, TD Ameritrade, and you tell Fidelity to directly put it into TD Ameritrade, that is not considered a rollover, and you can do as many of those as you want in a year. So again, a rollover is when you get a check and then you deposit it into another account. So the new ruling 2020-23, where you can replace your RMD, if you have already done a 12-month IRA rollover, you may not now do the replacement RMD. Okay, so now let's really just talk about what are the strategies that you can implement to try to take advantage of some of the things that are happening within the market. Well, let me go back. I'm going to go back to my original training and help you understand the 4 different tax strategies. Number 1, you can defer tax. When you defer tax, you want to ask yourself, what does the tax environment look like coming up? So for those of you that are deferring money into 401ks, for those of you that are still putting away money into an IRA, I would probably tell you now is not a good time to defer that. And the reason is if you defer any money in 2020, when we are now in the lowest tax bracket or the lowest tax scenario that our country has ever been in, then you may pay the price if they change the tax code to pay back this stimulus package. So deferral is it's not deducting, it's not saving, it's simply delaying when you're going to pay the tax. Because remember, if you take out $20,000 and you put it into a 401k, and right now, let's say that you are in an effective bracket of 15%, you are essentially deferring what you would pay now of 15%. If that was 20 grand, that would be $3,000. However, if when you retire, the tax bracket for you now goes up to 25%, you will now pay $5,000 to take that same money out that you deferred at $3,000. So wouldn't it be better just to pay the $3,000 right now, put it into a Roth, put it into a non-qualified account? Now, the second type is deducting. The deducting is where you take something and you deduct it against the taxable income that you have. So an example would be mortgage interest. If you change the way your mortgage interest is deductible, that may save you tax. If you pay ahead in 1 year, so under today's law, there's a very high, what they call standard deduction. And for many people that we do tax returns for, they don't qualify for the itemized deduction. That is where you add up medical, state income tax, property tax, charitable deductions, and mortgage interest. And for many people, the amount that they allow you to use as deductions in that area does not exceed the amount that you get as a standard deduction. However, you can stack it. In some scenarios, what you can do is you can prepay ahead on certain expenses so that in 1 year, your itemized deductions exceed the standard deduction. Then the next year, you go back to a standard deduction. The year after that, you stack the expenses and go itemized. So again, deducting, so we covered deferral, then there's deducting. The third one is, and let me give you a little insight. I would probably tell you when we do a tax look back, and a tax look back is when a new client hires us to say, I'm not really sure if I've been paying or if I've been overpaying, if my accountant or my CPA has been missing some things. So we'll do what's called a tax look back. And we'll traditionally do that for 3 years because if we find something, we can amend the returns 3 years back and get a refund. I will tell you probably in 95 to 98% of the time, if the person is using an accountant, a CPA, or even TurboTax for that matter, they're not missing deductions. Most people get the amount of deductions that they are entitled to. Where I find about 90% of people are missing the tax reduction, it's in the last two types of tax strategies. So far we covered tax deferral, tax deductions, but there are two more. The first one is offsetting, and the fourth one is shifting. So let me give you an example of shifting. Let's say that we have a physician and that physician has a 39, or let's say they live in a certain state, let's say they have a 45% combined tax bracket. And let's say that they have a child, and let's say that that child is, say, 15 years old. And that child might be coming into their medical practice and helping them empty a garbage can or file or whatever it is. That child might have a 15% tax bracket. So if we shifted some of the income from the physician at 45% tax bracket to the child at 15%, so you're saving 30% in tax by using another tax bracket. Now you have to make it legitimate. You have to have an employment contract. There have to be duties outlined. Again, I wouldn't suggest this for anybody under 13 years old, but that's just an example of shifting. Another example of shifting might be grandmother, grandfather. What they want to do is they want to shift dividends out of their control or out of their taxable situation. So what we'll do is we'll set up a 529. Now, what's interesting is most people believe that a 529 is only for college and it's for higher education. However, we've used it to shift. Why? Let's say that a person has investments and those investments are causing tax triggers like dividends or interest. Well, if we shifted those into the 529, there is no tax until the money is taken out. And here's the catch. If it is taken out for college or higher education, then it is 100% tax-free. However, if it is not used for those approved sources, there is tax and a 10% penalty, but only on the earnings. Now, the question is, can you arrange a certain year in which you withdraw money, the other income that you earn is less, so that the tax plus the 10% penalty together are even less than what you would have paid if you continued to have those dividends or interest come in. And the way that the tax system works is like a tax trigger. There is a tax trigger called IRMA. This is where if you earn too much money they will penalize you on your Medicare. It can go as high as $6,000 a year in penalties for a couple. So it can get pretty expensive. So is there a certain way you can shift that money to a different entity or qualification to get a reduced tax? Now, what's the last one? Offsets. There's a lot of offsets available today. And that's really what I want to talk about, is shifting and offsetting. So here's number one. What if we take the ability to replace the IRA, or let's use different language, we undo the IRA. And what we do is we take the shares that you took out, or we take the withdrawal that you took out, we replace it back into the IRA. So let's use an example. Here's the example. Let's say you borrowed out, you took out $100,000 in an RMD. Let's use something, a different number. Let's say you have $1 million in an IRA and you have 5% RMD percentage. And so you're going to take a $50,000 withdrawal. Now let's say that what you did is you satisfied that withdrawal by stock, and you withdrew $50,000 in stock shares so that you didn't have to sell it. But now, because the market has gone down, those same stock shares are now $35,000 valued. What you'd want to do is you'd want to replace those exact stock shares to your IRA. Then what you can do is you can then take them back out, and you're only paying taxes on $35,000. The second idea is you put them back into the IRA, or you create a Roth conversion. Now they're going to allow us to do this up until July 15th of 2020. What I'm trying to explain is that at this point, with this new IRS ruling, you have an opportunity to double check what the math is and take the best avenue. Now, who will this not help? This will not help you if you took your RMD between January 1st and January 31st, because this new ruling only applies to an RMD after February 1st. Two is this does not apply to anybody that has a beneficiary IRA. This is only for the primary account holder and the spouse of that account holder, but not children, grandchildren, or other beneficiaries. Hopefully that will help you navigate some of the complicated waters today of what's going on with the IRS, the stimulus checks, the changes in the RMDs, etc. Now, in the meantime, I want to bring your attention to another offer that I am still extending as long as supplies last. As you see, we're giving away the book that I wrote back in 2016 called Total Retirement Freedom. Now, this book goes through a lot of the tax strategies that I just talked about today, such as deferring, deducting, shifting, and offsetting. It will give you actual examples on how you can utilize that, but today's broadcast is really to help you understand what you can do within the next 60 to 90 days. But if you read the book, you'll also understand the premise, the foundation, and the structuring of what we're doing. Now, this book is free. We're not charging for it. We're not even charging the shipping for it. All you have to do is call the office, and we'll get you a copy out as soon as we get your request, up until the supplies run out. Also, I want to bring your attention to the schedule. If you want to go to the Facebook events, our Amabel has so kindly outlined all of the upcoming events. If you go to our company, Retirement Design and Management, you will find the events list there, and then this way you'll know what is coming up. You can also go to hhrdm.com /events, and there is a roster there of all the upcoming broadcasts. And with that in mind, I want to sign off, and hopefully this will be a great weekend for you. Stay at home, stay safe, keep your social distancing. We want everybody to survive this.